Good morning. It is Friday, March 27, 2026. This is your deep dive daily briefing. I am your anchor, Cora, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the strategic landscape of the Middle East has reached its most critical juncture since the start of the conflict. The 5-day military reprieve announced by the United States earlier this week is set to expire within the next 24 hours. Diplomatic cables from Geneva suggest that while a framework for a maritime security corridor has been drafted, a formal signature from the new Iranian leadership remains elusive. The White House has indicated that the next few hours will determine whether the region moves toward a sustainable ceasefire or enters a new, more intensive phase of kinetic operations. Regional monitors report that while major air strikes have paused, localized skirmishes continue near the border regions of Lebanon and northern Israel, maintaining a state of extreme fragility that has already displaced over 1 million people across the Levant.
Transitioning from the front lines of diplomacy to the broader global economy, the narrative is being driven by the structural consequences of the prolonged energy blockade. The OECD released its updated economic outlook yesterday, slightly revising the global growth projection for 2026 downward to 3.2%. This adjustment reflects the persistent friction in global trade and the high cost of energy that continues to weigh on industrial production in Europe and East Asia. While the 5-day pause in strikes provided a temporary cooling effect on crude oil prices, they remain significantly higher than pre-conflict levels, trading near $94 per barrel. Economists warn that the global economy is currently in a state of constrained stability, where any resumption of hostilities could immediately trigger a renewed inflationary spike that would complicate the efforts of central banks to manage a soft landing.
In the realm of finance, all eyes remain on the bond market as it processes the latest sovereign debt data amidst rising geopolitical risks. Global debt has now officially surpassed $315 trillion, a figure that represents roughly 330% of world GDP. This mounting debt burden is increasingly concentrated in advanced economies that are simultaneously ramping up defense spending and subsidizing the transition to artificial intelligence infrastructure. On Wall Street, financial strategists are closely monitoring the 10-year Treasury yield, which remains elevated as investors demand a higher risk premium for long-term assets. The financial sector is also bracing for the upcoming leadership transition at the Federal Reserve in May, as market participants seek clarity on whether the new administration will maintain the current hawkish stance in the face of stalling job gains and high borrowing costs.
Turning our attention to the technology sector, the focus remains on the rapid build-out of artificial intelligence hardware following the landmark GTC 2026 conference. Major cloud providers, including Microsoft Azure and Amazon Web Services, have confirmed a significant increase in capital expenditure for the second half of the year to secure the first shipments of the Blackwell Ultra architecture. This surge in demand is occurring as the industry faces a global power ceiling, with several firms now exploring direct investments in modular nuclear reactors to power their massive data centers. Simultaneously, the United States Department of Commerce has expanded its oversight of third-party semiconductor distributors to prevent the unauthorized transfer of advanced AI chips. These export controls are forcing a new wave of innovation in edge computing, where firms are prioritizing the development of low-power specialized silicon that can operate independently of centralized cloud networks.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, currently facing a period of intense structural rewiring. The de facto closure of the Strait of Hormuz has forced a massive return to the Cape of Good Hope routing, a detour that adds up to 14 days to voyage times and has triggered a 45% spike in air freight rates as shippers scramble for alternatives. Logistics providers warn that even if a permanent ceasefire is reached this weekend, the ripple effects on port capacity and container availability in hubs like Jebel Ali and Salalah will be felt well into the third quarter. As a result, 72% of trade professionals have now prioritized the adoption of AI-driven inventory positioning and regionalized supply chains. This shift away from just-in-time models toward a just-in-case strategy represents a permanent tax on global trade that will likely persist long after the current geopolitical tensions have subsided. That concludes our global briefing for today. Thank you for joining us. I am Vivian.